Tip of the day. Has anyone told you there are different types of coverages? For example, this term insurance covers a set period of time, like 10 years, 20 years, whereas permanent insurance gives you a lump sum of money upon your death to your beneficiaries. But there are different types of permanent insurance. For example, there is whole life, universal life, and variable life in the United States. What are they? And which one is the best? I'm going to tell you. Think of this way: term insurance. What do you want that used for? Basically, if you don't have enough money, you want to get term insurance, a convertible one for you to start out with. But most people use the term insurance if they want to use it as collateral to or leveraging what that policy against something else if they want to start a business. That's one. But the next thing is just temporary. The other benefit, if you're only going to be using it for a short period of time, you can use it and cancel it anytime you want. Whereas permanent insurance is a little bit different. You are going to be investing more money into it than the term insurance, but benefit for you. Think of how whole life is the most expensive, but it benefits you in this way. The money that you're investing inside it is growing on a creditative basis and is growing positive each year because it's paid in dividend forms, your investments. So it doesn't matter how any market does, you're still getting a certain set percentage with the dividends, which is always positive return. But if you're a little more, say, knowledge in the markets, go for the whole life. You want to take a little more risk, go for whole life, which is universal life. I mean, not whole life. If you want more risk, go for the universal life. Why? Because universal life is basically, you can say, like mutual funds. You invest your money and it'll grow correlated inside of it. And you have different types of, when you say companies, investments that you can use that are inside of it, exactly like mutual funds. But advantages for you. Main advantage is the money that's going on the inside of the whole life and universal life are creditor protected. So nobody can sue you and take the money at all. But the other benefit for you in whole life is you can use as collateral, but when you retire, you can use the money for your benefit. You can take it out and it doesn't affect your CPP or your old age. So both whole life and universal life, you can take the money out. It doesn't affect your CPP or old age. Now, in universal life, other advantages, the money's growing on a tax-free basis. But exactly like mutual funds, if you're growing your money at 15 to 20%, you don't pay tax on it versus the money on the outside. Plus, whatever the amount of money you have inside of it is private knowledge, not public, versus mutual funds on the outside, all your assets. Anybody can have a look and see exactly how much you own and how much you value. But in the universal life or whole life, the amount of money you have invested inside is private. So nobody will know exactly how much money you have inside of it invested. You can use a leverage, you can take the money out as money of your life for your benefit. That's your money. But if you invest it properly, you can have free insurance also. By the time you hit the 20th year, you should have enough money that you invested inside is equal to what you invested. So once that equal, you basically have life insurance free for the rest of your life. So at no cost to you. Think about it for your insurance. Now, that in place, but what are the other advantages? The advantages for you, one, use the money whenever you want because it's exactly like account. It's growing on a tax-free basis. You can use it, the money, when you retire. It doesn't affect your CPP or your old age. But if anything does happen along the time period, you can have the protection clause kicks in and you can use that for your beneficiary. So if something happens, your family still gets the protections that is on you, but you get to use the money that's inside of it for yourself. The other benefit, if you don't use all the money, you can actually give it to your great grandkids or your grandkids for them to start off with extra money and a head start. Think about it. You're compounding your money where you started at it from the beginning, from scratch, growing your money, but you in return giving money to your kids. You're only growing the money already. You can use that money and pass it to the next generation and keep on passing it. Whereas you right now might have $100,000 or $200,000 inside of your account, but think about your next generation, generation after. If you give some money of your life insurance policy over to them, they get to invest and get the start the $100,000 that you might want you pass on to them, and the next generation goes to $200,000 to $300,000 to the next generation. If you do that constantly over the time period, your family's generation, you can change history, will be well off, and you don't even have to worry about money at all. You can have millions of dollars just by starting a simple plan with life insurance.